Okay, so now we have a plan and we have to get the job done and execute. What are the tools that we're going to use? We're going to look at fundamental analysis, technical analysis, and a funny story is when I first started working at National Bank as a market maker and pro trader, I was a young guy in my 20s, and I walked in and I'd been obsessed with technical analysis and I'd been swing trading and everything, and I was aware of fundamental analysis because I'd read Bill O'Neill. And when I got there, everyone on the trading desk, which were ex-floor traders, they were looking at me and kind of laughing and sneering at the fact that I had all these charts and oscillators and indicators going. And what they were doing, they were tape reading. So there's really three key elements here: fundamental analysis, technical analysis, and tape reading. But the tape reading aspect of what I learned, I've really learned to incorporate into technical analysis. And that's the core of what we're going to do later on, about how I bring that subtlety of understanding order flow and what's going on with the minute detail of buying and selling in the marketplace, and how we use that knowledge to apply it to technical patterns and tools. But what we're going to start with here is fundamental analysis. But the truth is that traditionally, investors would invest in silos. Bill O'Neill is really one of the first people to have changed that, and by looking at both fundamental and technical analysis. In fact, when I started, most of the technical analysis books I read were by commodity traders and were about futures trading. And for that reason, also because of the fact that there was a rise of China in the 2000s and commodities were all in big bull markets, I had originally shifted from CAN-SLIM investing and the teachings of William O'Neill, and I became primarily technical analysis based, and I was a swing trader in commodities and futures, which really helped me out when I started my job as a market maker and pro trader because it was so short-term oriented. But at that time, stock investors were primarily fundamentally driven. In terms, they looked at earnings, they looked at sales, and that's really what they used to make their investing decisions. And technical analysis was really relegated more to the very active professional, the floor trader, the day trader. And it's taken a long time. I think it's pretty evident in the industry now that technical analysis is viewed with respect, because if you look at all the majority of volume that trades each day, it's algorithmically traded, and algos are not using fundamental ratios. They're looking at technical data. It may not be charts, but they're looking at the same technical information, such as bid, offers, price changes, closes, that a technical analyst will apply to a chart. So it's clear that over time, technical analysis has proved its worth in the investing decision process. But really, each tool has its pros and cons. So we do want to use the best of all worlds here. And fundamental analysis is great, but it doesn't have any risk management. There's no market or investor sentiment input. How do you know if you're right, or how do you know if the market is agreeing with your thoughts? Maybe you're completely off track and there's information out there that you're just not aware of. And that's really what technical analysis will bring to the equation. If you are really excited about a company and its prospects, yet the stock is in a big downtrend, or you see clear selling signals based on your tools, well, you can wait, put the stock aside and wait for it to settle down and provide a low risk entry. And that's really not possible with fundamental analysis. I mean, how do you even limit your risk? If you're looking at the stock from a fundamental perspective, the lower the price goes, the greater the value is. And that's really what they call the value trap. And so how do you limit your risk in a situation like that? And to really have outsized, enormous returns, you really need to have controlled risk and very large gains. So when you're wrong, it doesn't really hurt you, and when you're right, you make a lot of money. Now, how do you do that if fundamental analysis is your only tool? How do you limit your downside? How do you know where you're wrong? And that's what technical analysis really brings to the equation. However, this section is on fundamental analysis, and so if technical analysis is so great, why do we even need anything else? Well, it's not really possible to narrow down the stocks according to long-term potential with technical analysis only. I mean, how do you know which companies will have the largest returns, the largest possible moves in the future? That's really provided by fundamental analysis. Also, I like Mike Tyson's quote where he says, everybody has a plan until they're punched in the face. And that's really true. I mean, even if you're in a strong uptrend, if your stock starts to have a rather significant pullback, which may be normal by technical terms, it's very difficult to sit through unless you have a real thorough understanding of what the company is and what its growth prospects are and why you own the company in the first place. And that's really what fundamental analysis brings. It allows you to narrow your list of stocks into a universe of very large potential winners, and it helps for you to understand why you're holding the stock for the long term, even during points of time where you're not getting maximum upside return, and there's other opportunities that are looking great at that moment. Now, the irony is that fundamental analysis drives all of these big moves. We're going to jump in and look at a bunch of charts and look at the key variables and the key factors that prove this out. But most active investors really watch charts. I think that comes down to the fact that you're constantly looking for that next great setup, and fundamentals just don't change from day to day, but stock charts and price action does. But it's really important that whenever you're going through all the other chart patterns, which we're going to go through, which we're going to spend a lot of time on, that you always recenter and refocus yourself on the fundamental story, because it's so important. Without that fundamental story, a stock will not advance tenfold unless there's something dramatic going on with the company. But what are we trying to really accomplish with fundamental analysis? I mean, all of those metrics are old. Everybody knows last quarter what the earnings were. And this is not 60 years ago where information is really only relegated to a few people who have access. With the internet, everything is readily available. So why look at older metrics? Well, the best way I like to explain it is, in the commodity business, I traded commodity stocks for many years when I was a market maker with National Bank. And the saying is, the best place to find a gold mine is next to a gold mine. And it's really true. I mean, of all the earth on planet Earth that's available to mine for gold, the best place to find a gold mine is if that strike of gold continues outside the borders of an existing mine. That's the highest probability. So the same goes with fundamental analysis in all of these financial metrics. If you're looking for enormous earnings growth or enormous sales growth, the best company to find is one that has already been proven to do it. So what are the odds that a company that has a 10% reduction in sales last quarter to suddenly post an 80% increase in sales? The likelihood is very low. It's not impossible, but it's very low. And what we're really trying to do is to find a company growing with a large trajectory. They're onto a new product, a new service, a new technology, or a new industry change that will last for quite a period of time as they fully exploit this market opportunity. As they do that, institutions will be buying that stock for months and months at a time, because these are ginormous funds. I mean, the Fidelity Contra Fund, probably the largest growth fund in the world, one fund alone has a market value of over $130 billion. So if they want a 3% allocation, think of the amount of buying that they will have to do in a stock. And that doesn't happen overnight. I mean, that's a real advantage that we have as individual investors versus the institutions. So again, the best place to find a gold mine is next to a gold mine. You want to find a stock that is already growing. You want to understand what the story is behind those numbers, and you want to try and understand if that story is likely to continue. But what happens, I know sometimes people are frustrated. They don't like to be held back by requiring to have these numbers. I mean, what if you have a great thesis about Tesla or Bitcoin or something that you think is the next big thing? Well, to be honest, all the biggest winners have had that fundamental information. Maybe you are early, maybe you're onto something, maybe you're an industry insider where those numbers are just around the corner and haven't exited yet, and they'll be out shortly. Well, in that situation, you at least want to have your technical tools to see if other investors are also recognizing the changes and dynamics in the business of this company, and if it's being reflected in the stock price. Because the truth is, even if you are right, but you're so early, being too early in the market is often the same as being wrong, because your capital could have been used elsewhere. How early is too early? I mean, what if you're 3 months early? That's not so bad, but what if you're 4 years early? And what if that story never does pan out? Maybe you think you have this great product that's being developed, yet it never gets to market, or a competitor that you were unaware of gets to market first and takes the market opportunity. That's why you always want to confirm with technical analysis. But I would say, if the fundamentals are not there, you can go after an idea if you think they are yet to come. But keep in mind, the biggest winners did show fantastic earnings growth and sales growth and all the other key metrics that we're going to look at. So it's not impossible, but this is all a probability business. And so you want to have as much odds on your side as possible. So if you have those big numbers, it's more likely that you have a giant winner. Or another situation, what if you see these great numbers, but you just don't understand the story? I mean, many times I'd see a biotech company with these fantastic earnings numbers or huge sales numbers, and I have just no idea what it is that they're doing. Well, the best way I go about it is, first place I like to go is their website. Basically look at their products and see if I can understand that. If that's still over my head, I'll go to the investor relations website of the company. Usually they have an investor presentation where it's kind of brought down into terms that an investor would understand who is not specific to the industry. I also go to YouTube. There's either company videos, or if it's a consumer-oriented product, there's usually consumer videos where they review a product or discuss it. I check out competitor websites. Sometimes they just have a better way of communicating the reason for the product being so successful. And lastly, I'll look at online forums. There's many ways to learn about a company, but if you just still cannot understand the story of a stock after doing all of that, myself personally, I will step away and try to find a company that I'll try and be able to understand more about it. And the reason is you lose that conviction that you would have if you otherwise knew what the company was doing. And that conviction is really important because the market is not always a friendly place, and in those more turbulent times, it is definitely an asset to be able to understand what the company is doing, and it'll also, if there are dramatic changes, it'll help you to react quicker and understand if maybe their competitive advantage is going away. For example, if you have a company with a product that you know very well and you think has this great long-term prospect, and you know this product fantastic, and suddenly a new product is brought to market, and you see the stock selling off, a sell signal is flagged, and you also know, wow, this is really a much better mousetrap. This is something that is way better than what the company you own is currently offering. It'll allow you to pivot that much faster. So that's why it's so great to always understand the story behind the company. And the truth is, this becomes easier with time. So I know maybe when you first start reading about perhaps artificial intelligence or software as a service or all of these other things that are new in the marketplace, first of all, it'll be difficult to understand at first because all these great companies are doing something new. And something new is you're probably not comfortable with or you're not very knowledgeable about. But once you learn about how one company is applying AI and how one company is introducing a new product, eventually these trends will start to kind of interlope and become linked over time, and it'll be much easier for you to understand the story. So just as you spend a lot of time scanning for fundamental criteria, looking at stock charts, I would also dive deeply into stocks that you find of interest and really look at the product. Read the annual reports. What is the management plan and how do they see the industry shaping out? Because most often the CEO will have a letter or a presentation where he explicitly says what his vision is for the future for the industry. And even if it doesn't pan out, that knowledge will help you down the line to understand other companies doing similar things.